Namaskar and welcome to Sunset Television. I am Vishal Dahiya and you're watching our special show Perspective, where we bring you detailed analysis of all key national and international issues. Today we're going to talk about global tax reform, specifically the corporate tax. Now, after years of intensive negotiations to bring the international tax system into the 21st century, 136 countries have reached an agreement on the two-pillar solution to address the tax challenges arising from the digitization of the economy. Now, this two-pillar solution will now be delivered to the G20 finance ministers meeting in Washington, D.C. on 13th of October, and then to the G20 leaders summit and at the end of the month in Rome this month. Now, the global minimum tax agreement does not seek to eliminate tax competition, but puts multilaterally agreed limitations on it. Under Pillar 1 of the agreement, taxing rights on more than $125 billion of profit are expected to be reallocated to the market jurisdictions each year. Pillar 2 of this agreement introduces a global minimum corporate tax of 15%. Now, the new minimum tax rate will apply to companies with revenue above 750 million euros and is expected to generate around $150 billion in additional global tax revenues annually. Further, benefits are also expected from the stabilization of the international tax system and the increased tax certainty for taxpayers, tax administrators. Today, we will discuss and analyze all aspects of this issue and also understand its impact on India and other developing nations. And for more on this, we're joined by a distinguished panel of experts. Let me first introduce them to you, beginning with, we have with us in the studio Shubhmoy Bhattacharya. Shubhmoy Bhattacharya, he's a consulting editor with the Business Standard. We're also joined by two more guests. Ms. Neeru Ahuja is joining us. She is chairperson of CII's core committee on BEPS, and Professor Sol Pichocto is also joining us. He's a senior fellow ICDT United Kingdom and he's joining us from Spain. Welcome all of you to Sunset Television. Let me begin with you, Shubhmoy, first. And let's start by addressing the basic question here. Why are we now talking about the global tax reforms? One, and two, what is this global corporate tax limitation which we are looking at?
You know, Vishal, the global tax reform is something that has been a work in progress for some years. There are lots of reasons because of which countries have been saying that we need to have a harmonized system of taxation on corporates. There are issues of equity. There are issues regarding global intergenerational equity. Lots of stuff that has been coming along. But broadly, it was proving difficult because countries, for various reasons, basically to attract investment, were sort of fighting among themselves with tax. We have a particular similar in India. In India, states used to have go in for this tax benefits to each other to attract companies, and to eliminate which we went in for the VAT and then the GST. So that of course was an indirect tax. This is a direct tax reform, but the principle is the same. So what has happened is that the tax regime across countries has sought to be equalized for the corporations, and as you said in the initial remarks, the rates are being fixed. So there are two pillars to it broadly. One is that all the companies will at least pay a global minimum tax of 15%. That's first thing. The second part is that within those, what is the taxation rate that each countries will have on the profits that the companies will pay, what percentage of the profits that will be paid on. So it is a very far-reaching reform. It's probably, I mean, I wouldn't say that there were, or rather, there have been anything similar for decades in the global economic architecture. WTO has been fraught with differences. There are hardly any area where we have had such a wide-ranging, what I should call harmonization. And as you said, 136 countries have agreed with OECD. Because why with OECD? Because OECD was actually spearheading the tax formulation, the nitty-gritties, the details of how the tax will be done. That had been given to OECD, and OECD has come up with the document which has been agreed on. Now that document will travel to the G20 finance ministers and then the G20 heads of state. And then from there it comes back again to the respective state country legislatures, who then take the necessary tax legislations to bring it, to make it reality for all the companies across the world. So in a nutshell, that is about it.
So the timeline, if you look at, there is still, a time for this to be operationalized, but this is indeed a very significant step with all 136 nations agreeing to that. And a few more likely to do so. Let me bring in the other two guests here as well. Professor Soul, I'd like to start with you first. As Shubhmoy was pointing out, and as has been stated in the OECD statement also, that digitization of economies around the world did point out a need to go ahead for these sort of tax reforms at a global level. What we want to understand is what are the tangible, achievable targets of these sort of tax reforms, which once put in place, how will they work around as well?
Well, I think it's right to say that this is a long-standing problem. The effort was begun, in fact, way back in 2012 by the OECD, but the OECD countries realized they couldn't do it by themselves because that left out many important countries, including India, of course. So they then recommended to the G20, and the G20 backed it. And G20 member countries that weren't already OECD members, like India, joined in the effort from 2013. And the goal laid down by the G20 was to reform international tax rules so that multinational companies could be taxed where real activities take place, because the old international tax rules devised nearly 100 years ago are really completely defective for the modern world of globalization. So they would try to do that really for 8 or 9 years and really made rather little progress. There were many recommendations made which made the rules more complicated. And it's only since 2018, 2019 that they've addressed the issue more directly in the context of digitalization of the economy. But digitalization means that the whole economy, they found, there was a big report as part of the whole BEPS project, that digitalization affects the whole economy. And in fact, there's been a shift to services, and digitalized services are only part of that. So the problem of what can we achieve immediately, we need to both resolve the problem of the highly digitalized companies, but also really move towards reforming the international tax rules as a whole to tax multinationals as the G20 required where their activities take place.
Okay. That explains the rationale behind going in for such tax reforms at a global level. Let's look at the industry perspective also right now. Ms. Neeru Ahuja is with us. She's the chairperson of CII's core committee on BEPS. Ms. Ahuja, from the industry's perspective, how significant is this, and how will it help corporations not only in India but globally?
Right. Thank you for that question. I think large multinationals which operate in multiple countries across the world will really welcome this consensus. I think it's really historical what has been achieved. I don't think ever in the history of global taxation such a big achievement has happened, where around 140 countries have agreed on how to tax multinationals. So I think from the corporate sector, this is welcome. They are now more sure of how they will be taxed, where they will be taxed, what tax costs would arise. Otherwise, they were living in a world of a lot of tax disputes. Country A and country B would not see eye to eye as to what their taxation rights were, which resulted very often in double taxation of elements of income. So I think corporates will welcome this political consensus. The only challenge today is that the agreement relates to very large multinational groups, and perhaps over the years we will see the smaller corporates also getting the benefit.
Okay. Indeed, that's going to be a very interesting part, an important part to look at. Let's look at the intricacies now. And before I come to you, Shubhmoy, I'll go back to Professor Soul here. Professor Soul, if we are looking at the working mechanism of, how this actual reform process will be implemented on the ground there. Now, we would like to understand a few aspects. And I'm reading from Pillar 1. Under Pillar 1, it says taxing rights on more than 125 billion of US dollars of profit are expected to be reallocated to market jurisdiction each year. Now, how do you explain that? What does it actually mean when it says that market jurisdiction each year?
Well, first of all, I think, as Ms. Ahuja rightly said, it's important to bear in mind it will only apply to 100, the 100 biggest and most profitable companies.
Okay.
So the vast majority of multinationals will be left out of Pillar 1. Secondly, it only applies to a small proportion of the profits of even those companies. There will be a formulaic method, so it is a step forward that those 100 companies will be taxed according to the economic reality that they are global players. But only a small proportion of their profits, around 20 or 25%, would be allocated to market jurisdictions by a formulaic method. The remainder of their profits would still have to be taxed according to the existing rules, which do create conflict. So there I'm not in agreement with Ms. Ahuja. I think that the problems and conflicts will remain because the existing rules will continue to apply to the bulk of the profits, even of these 100,
Okay.
but also to all the other multinational companies. So I fear that this will not resolve all the conflicts of the future.
Shubhoy, do you agree with what Professor Soul is saying, that yes, this is a significant step forward, but there will have to be a lot of work which needs to be done now when you want to involve everybody, as Ms. Ahuja was also pointing out, because this, as of now, addresses the large corporations, the companies with huge profits there.
Exactly. I mean, the professor is absolutely right. In fact, this top 100 company formulation was the US formulation. OECD actually wanted it to be far deeper. And that wasn't agreed to. That was a bit of a divide between the two sides of the Atlantic. For countries like India, there's an added problem that they've already gone in for a digital tax, what is known as equalization levy. And the interesting thing about tax is that once it's imposed and once the gravy train starts, it becomes difficult for a tax jurisdiction to say, I switch that off and I go on to something else, which might be equally good, but which may not be good.
But taxation is also a sovereign right.
Absolutely. So that's the point. So now the equalization levy has already started giving countries like India a good amount of tax. Now our negotiators will be saying that what does this 100 top company business mean, because many of these companies actually have profits of less than 10% on the global profits. So which means that essentially they will not be taxed. By the Indian formulation, for instance, these companies get taxed. So we are going to give up a bit of a tax right, and that, as I said, the gravy, for a global sort of commons in which, again, countries would say that I want a compensation. Now, how would that compensation come in wouldn't be clear, because there's no compensation formula as such, excepting for the least developed countries. So there are those challenges. Also, as the professor rightly pointed out, these are essentially, because of the nature of the taxation, it essentially will apply to digital companies. So a big company like let's say a company like, say, RIL, which is a big company, but it's essentially within India. It doesn't come within that formula. So the taxation regime will be different. So whereas TCS comes in. So there are those things that need to be sorted out. So yes, there is plenty of work ahead before we can sign on saying that this is happening.
That's a very interesting aspect. I'd like to bring Professor Soul again here. Professor Soul, how do you view this issue of equalization levy, one, and two, the fact that the agreement would have been signed by 136 countries, more nations might also sign it, but then taxation remains the sovereign right of every country?
Yeah, that's very, very important. I mean, firstly, to correct you a little bit, although the OECD has said it's nearly 140 countries, in fact, that includes jurisdictions which are not sovereign states. It includes many which are, in fact, tax havens, like the Cayman Islands, like Jersey. So, in fact, there are fewer, I think it's around 119 actual states. And it does include a very large number of United Nations members. And in fact, most of the less developed countries are not included, are not even part of the inclusive framework. So quite a lot of countries are not included. And some significant ones that were part have decided not to join, even at this stage. Now, although India and others have not said they wouldn't join, I think that's partly because there's significant issues do remain about things like the equalization levy, because conditional on accepting Pillar 1 would be to withdraw existing measures, and it says such as digital services taxes and similar measures.
Okay.
Now, I think it's likely equalization levy will be considered a similar measure. The question is, should it be withdrawn for all companies that are within its scope, or only for the 100 which would be covered by the new proposal? And obviously, it would be giving up unilateral or a state sovereign right to tax, to say we won't tax many companies, even if they're not covered by this new proposal. And I think might be difficult for India and other countries to accept.
Okay, that's a very, very important aspect there. Ms. Ahuja, your viewpoint and the industry, how it looks at this issue of equalization levy and in the overall mechanism, if you're looking at once the train starts rolling vis-a-vis these global tax reforms, how do you think it'll work out?
Right. So, Vishal, equalization levy, as you know, and as my co-speakers have said, was India's form of digital tax, which was imposed because in the last few years, a lot of debates and discussions had been going on, but the political consensus had not been reached. Many countries started to impose the unilateral tax measures, and India, of course, introduced equalization levy on services and goods supplied by e-commerce companies not having physical presence in India. And this tax was imposed on 1st of April 2020. At that time, the understanding was, in case there is a multilateral agreement which is achieved between G20 and the larger group of countries, this tax will be withdrawn. That was the broad understanding. And that is what the industry actually expects. Now, the finer point of for whom the taxes should be withdrawn, should it be only for the companies who end up being in those top 100, whether it should be for all? That is a question we don't have an answer yet. Perhaps the governments will work together and finalize the approach to that. But certainly, I think the industry will expect equalization levy to be withdrawn sooner or later.
Okay, that's about the industries, the companies out there. But Shubhmoy, let's look at the other aspect of it. Obviously, which companies will be taxed, how much will the taxation will be, and will it be just the large corporations, or when will the smaller companies be a part of it? Equalization levy becomes a very significant aspect here. But the most important question here is, will it also bring parity between the economies, developed and developing, when we're talking about, share in the tax profits there? That's seemingly one of the major points.
Well, this is something on which OECD, for instance, has been working a lot. And they have some very extremely good set of analysis on tax issues, international tax parity. As you know, there's been a lot of discussion, which Professor pointed out, about tax havens, which have been, to some extent, often act as conduits for tax arbitrage between nations, where typically the least developed countries suffer. India, for its part, the interesting thing is, obviously the international understanding is that tax should not be the reason why companies set up bases in different countries. It should be the country's respective ability to create a more level playing field in terms of having uniform legislation, better legislation for infrastructure, for ensuring other stuff that should attract investment rather than tax arbitrage. So to that extent, it's a wonderful idea. Having said that, the point is that there's no doubt that countries like India will be expecting to pull in more investment. And when it does pull in more investment, the tax issues with the companies which are coming in, there will be differences. Now, how those differences get sorted out are not just about this tax. There's also the issue of what we know, the retrospective tax, or the tax FTAs between countries. India has actually taken a very progressive stance. I mean, it has already removed the retrospective tax.
Tax is done away with.
It has also decided to go in for FTAs with several countries. The one with UK as well as the one with the EU are already in the works. So those would also be coming in. So it is a very interesting, to that extent, the global minimum tax complements the international tax structure that is being built, and to that, and therefore it's welcome.
Okay.
But I would think that the timeline is difficult. The 2022 and the 2023, by which it's supposed to be done, looks a bit tight as of now.
Okay.
Of course, this is something on which Ms. Ahuja and Professor Saul Pachetu will be able to say better.
Okay.
To me, it looks difficult at this moment.
Well, these are international negotiations, and I agree with you, Shubhmoy, there that it takes time when you're negotiating between nations, and there are too more than 130, 140 nations trying to come to common ground there. Professor Saul, from your point of view, sir, what is in it for the developing nations and specifically rapidly developing economies?
Well, at the moment, as I say, I think particularly for the lower income countries, really not very much, which is why countries like Nigeria and Kenya have refused to join, and others are not even participating. Just to go back even to countries like India, I mean, India does have an alternative. Even if it is likely India would withdraw the equalization levy, India already has on the books a proposal based on significant economic presence. Okay. This would mean that a non-resident company that doesn't have a physical presence, but still has a significant economic presence in the country, could be declared taxable and taxed on a proportion of its profits. And that may be what India would want to strengthen. And I think that's very important if you look at the purpose of international tax rules to encourage investment. Okay. Because after all, restricting a state's rights to tax non-resident companies actually discourages investment. If companies can sell significant services in particular within a country without any physical presence, they're not investing in the country. Okay. And this is really choking off economic development within the country for the benefit of non-resident companies, which are not even taxed on their profits in the country. Okay. So this is really a very serious question for countries that are capital importing, which most of the poor countries are.
Okay, indeed, and that's a question which the negotiators will have to answer there when they again sit at the table. Ms. Ahuja, quick concluding comment from you on this issue itself when we're talking about how will the developing countries benefit from it, and not only the rapidly developing, but as Professor Saul was pointing out, the least developed countries as well.
Sure. I think this is a very important move for developing countries and emerging economies. And I think India has been fighting for these taxation rights since long. India has been raising their voice that we have such a large market, such a large consumer base. And as Professor said, the multinationals, the very large technology giants have been using our large customer base, earning revenues, earning profits, and India has not had this taxing right in the past because they never had a physical establishment in India. Okay. So I think for countries like India and even the smaller countries which have large market bases, which have large consumer base, this is a big, very important step in international taxation. At least the right to tax has been squarely recognized. Okay. I think that is a very big win for us.
Okay, there it is. It is indeed a very significant decision being taken, the agreement being signed, and we'll have to wait and watch what happens. Thank you so much, Ms. Ahuja, as well as Professor Saul and Shubhmoy for sharing your views and insights with us. And our viewers, as our experts were pointing out, a very important agreement that has been signed with the global tax reforms, but there are some issues which still need to be ironed out, challenges which will need to be tackled during the negotiations to ensure that all stakeholders do get their due benefit from this agreement. We'll come back again with a different topic. Till then, keep watching Sunset Television. Thank you.